When I was 25 years old, I made a decision that I thought would change my financial future forever. I decided to invest in the US stock market, dreaming of quick profits and financial freedom. One of my friends raved about a hot stock that everyone was talking about. It seemed like a golden opportunity, so without much thought, I poured all my savings into it. At first, the numbers went up, and I felt invincible. But within weeks, the market shifted, and before I could react, I lost everything I had worked so hard to save. That experience was devastating, but it became one of the most valuable lessons of my life. Looking back now, I realize how avoidable that mistake was if only I had known some critical principles of investing. I don't want anyone else to go through the same pain I did. In this video, I'll share the most important lessons I've learned from that failure. Lessons that can help you navigate the stock market more confidently and avoid costly mistakes. By the end, you'll understand the key principles that every investor should know to minimize risk while maximizing potential rewards. The topic for today's video is stock market investing, essential tips to reduce risk. Whether you're a beginner or someone with some experience, these insights could be the game changer you need. So, stay tuned, explore practical strategies, real-life examples, and expert advice that can help secure your investments and build a stronger financial future. Let's dive in. Because understanding the rules of the game is the first step to winning it. The stock market holds tremendous potential for growing wealth, but it also comes with risks that can derail your financial goals if not navigated carefully. Many investors, especially beginners, often make mistakes that are easily avoidable with the right knowledge and mindset. In this section, we'll explore the most common errors investors make and how to avoid falling into these traps. 1. Investing based on emotions. One of the biggest mistakes is letting emotions dictate your investment decisions. When markets soar, the fear of missing out, FOMO, can cloud judgment. This psychological bias often leads to rash decisions, like chasing hot stocks or following the herd. A classic example of this is the dot-com bubble of the late 1990s and early 2000s. At the time, tech companies were skyrocketing in valuation, and investors scrambled to buy shares of internet-based businesses, many of which had no proven revenue models. When the bubble burst, over $5 trillion in market value evaporated, leaving many investors with heavy losses. The lesson here is to make data-driven decisions rather than reacting to market hype. Always ask yourself, is this a sound investment based on fundamentals, or am I getting swept up in the excitement? 2. Lack of knowledge. Jumping into the stock market without sufficient knowledge is like sailing into a storm without a map or compass. Many new investors don't take the time to understand the basics of the market, such as the difference between growth and value stocks, how market cycles work, or the factors that drive stock prices, like earnings reports, macroeconomic indicators, and global events. For instance, some investors mistakenly equate penny stocks with great opportunities due to their low cost. However, penny stocks often carry much higher risks due to their lack of liquidity and the tendency for price manipulation. Conversely, blue chip stocks might appear boring, but they often provide steady, long-term growth. Without a solid understanding of these dynamics, you might end up chasing short-term gains while ignoring the bigger picture. Take the time to educate yourself through books, courses, or trusted online resources. Knowledge is your best defense against poor decisions. 3. Poor risk management. A key component of successful investing is managing risk effectively, but many people overlook this critical step. One of the most common mistakes is failing to diversify. When you put all your money into a single stock or sector, you expose yourself to significant risk if that particular investment performs poorly. Consider the saying, don't put all your eggs in one basket. If the basket drops, you lose everything. Similarly, if you invest all your capital in one stock or a single industry, an unexpected downturn could wipe out your portfolio. Diversifying your investments across various sectors, industries, and even asset classes, like bonds or real estate, helps mitigate this risk. Another aspect of risk management is asset allocation. Depending on your age, income, and financial goals, you should determine how much to allocate to stocks, bonds, or other investment types. For instance, younger investors may tolerate more risk with higher exposure to stocks, while older investors might prefer safer income-generating assets. Remember 4. Unrealistic profit expectations. Social media and advertisements often paint an unrealistic picture of investing. Stories of people doubling or tripling their investments overnight can create a false sense of what's achievable, leading many to chase unsustainable returns. While there are rare instances of windfall profits, the truth is that successful investing is a long-term endeavor. Historically, the S&P 500 has delivered average annual returns of around 7 to 10%, including periods of volatility. Expecting consistent 50% returns or worse following get-rich-quick schemes often results in disappointment or significant losses. Instead, focus on setting realistic goals. Understand that the power of compounding works best over time, and patience is often more rewarding than risky bets. For instance, investing $500 per month in a diversified portfolio with an average annual return of 8% could grow to over $150,000 in 15 years, a testament to the value of long-term investing. The 5. Failing to learn from mistakes. Another critical misstep is not reflecting on past errors. Investing involves trial and error, and even seasoned professionals make mistakes. However, the difference between successful and unsuccessful investors often lies in their ability to learn and adapt. Take the time to analyze your past investments. Did you buy a stock based on hype? Did you panic sell during a downturn? Identifying these patterns helps you refine your strategy and avoid repeating the same mistakes. Avoiding these mistakes to succeed in the stock market, it's essential to approach investing with the right mindset and preparation. Avoid emotional decision-making by relying on research and analysis. Take the time to educate yourself about market fundamentals and trends. Diversify your portfolio and establish a risk management plan tailored to your goals. Most importantly, set realistic expectations and view investing as a marathon rather than a sprint. By steering clear of these common errors, you can build a solid foundation for long-term success in the stock market. Remember, the best investors aren't those who make the fewest mistakes. It's those who learn and grow from them. In the next section, we'll dive into actionable tips and strategies to help you make informed decisions, reduce risks, and maximize returns. Stay tuned. Key principles to minimize risk in stock market investing. Investing in the stock market offers an incredible opportunity to grow wealth over time, but it's not without risks. To succeed and minimize potential losses, it's essential to follow certain guiding principles. These strategies ensure you make informed decisions, manage risks effectively, and build a portfolio that aligns with your financial goals. Let's explore the foundational principles every investor should know. 1. Define your investment goals and risk tolerance before you invest a single dollar. Take time to understand your financial objectives and assess your tolerance for risk. This clarity will guide your decisions and prevent you from making rash moves when market conditions change. Short-term versus long-term goals. Are you investing to save for a vacation next year, or are you building a retirement fund over 20 years? Short-term goals often require lower risk investments, such as bonds or money market funds, as they offer more stability. Long-term goals can withstand market fluctuations, making higher risk assets like stocks a suitable option for potentially greater returns. Assessing risk tolerance. Risk tolerance varies by individual. It's influenced by factors like age, income, and financial responsibilities. Low risk tolerance. Prefer safe investments, such as bonds or blue chip stocks, that offer lower but stable returns. Moderate risk tolerance. Comfortable with a balanced portfolio of stocks and bonds, accepting some volatility for moderate returns. High risk tolerance. Willing to take on significant market swings, investing in growth stocks or emerging markets for higher potential rewards. Understanding where you fall on this spectrum will help you choose investments that align with your comfort level and financial timeline. 2. Conduct thorough research before investing. Investing without knowledge is akin to gambling. To make informed decisions, conduct both fundamental and technical analyses on the companies or securities you're considering. Fundamental analysis. This approach evaluates a company's overall health and future potential. Key factors to analyze include revenue and profits. Is the company consistently generating profits? Growth potential. Does it operate in a growing industry, and does it have a competitive advantage? Leadership. Is the management team experienced and capable of navigating market challenges? For example, a company with strong quarterly earnings reports, low debt levels, and innovative leadership is likely a solid investment. Accessing financial statements through official sources, such as the company's website or government filings, provides reliable information. Technical analysis. This method involves studying price charts and using indicators like moving averages or RSI, relative strength index, to identify patterns and trends. For instance, technical analysis might reveal whether a stock is overbought or oversold, helping you time your entry or exit points effectively. Use trusted sources, rely on credible platforms like financial news outlets, stock market analysis websites, or official company filings. Avoid acting on rumors or unverified tips, as they can lead to significant losses. 3. Diversify your portfolio and allocate assets. The golden rule of investing is diversification. Never put all your eggs in one basket. A well-diversified portfolio helps spread risk and reduces the impact of any single investment's poor performance. Asset allocation. Allocate your investments across various asset classes, such as stocks, bonds, real estate, and mutual funds. The ideal mix depends on your risk tolerance and investment goals. For instance, a conservative investor might allocate 60% to bonds, 30% to blue-chip stocks, and 10% to real estate. An aggressive investor might lean towards 70% growth stocks, 20% bonds, and 10% alternative assets like cryptocurrencies. Industry diversification. Don't concentrate all your investments in one sector. If you invest solely in technology stocks, your portfolio is vulnerable to a downturn in that industry. Instead, diversify across sectors like healthcare, energy, and consumer goods to balance risks. For example, while tech stocks may offer high returns, adding stable sectors like healthcare or utilities can provide a cushion during market volatility. Number 4. Manage your emotions. Investing can be an emotional roller coaster. Market swings often trigger fear or greed, leading to poor decisions. Learning to manage your emotions is crucial for long-term success. Discipline over panic. One of the most common mistakes is panic selling during a market downturn. For example, during the 2008 financial crisis, many investors sold off their stocks at a loss, only to see markets recover later. Staying disciplined and holding on to quality investments often pays off in the long run. Patience is key. Successful investing requires patience. Rather than chasing quick gains, focus on long-term growth. Wait for the right opportunities to buy undervalued stocks or sell at a profitable price point. Avoid overreacting to market noise. Not every headline warrants action. Markets are naturally volatile, and reacting to every fluctuation can derail your strategy. Instead, focus on your long-term plan and trust your research. 5. Continuously educate yourself and stay informed. The financial world is dynamic, and staying updated is essential to making informed decisions. Expand your knowledge, take courses, read books, and attend seminars to deepen your understanding of investing. Some popular resources include books, The Intelligent Investor by Benjamin Graham, or A Random Walk Down Wall Street by Burton Malkiel. Courses. Online platforms like Coursera or Khan Academy offer investment courses. Follow market trends. Keep an eye on economic and political developments that can influence market performance. For instance, interest rate changes, inflation reports, or geopolitical events often impact stock prices. Join communities, engage with investment forums or social media groups where experts share insights. Platforms like Seeking Alpha or Reddit's r/investing can provide valuable perspectives, though always verify information independently. Practical example of applying these principles. Imagine you're interested in investing $10,000. Here's how you could apply these principles. 1. Define goals and risk. You decide to invest for retirement, 20 years away, and are comfortable with moderate risk. 2. Research companies. After thorough research, you choose to invest in 3 companies: a tech firm with strong growth potential, a healthcare giant with stable earnings, and an energy company offering dividends. 3. Diversify. You allocate $6,000 to stocks, $3,000 to a bond ETF for stability, and $1,000 to a REIT, real estate investment trust, for diversification. 4. Manage emotions. When the tech firm's stock drops 10% during a market correction, you resist the urge to sell, knowing the fundamentals remain strong. 5. Stay informed. You regularly review your portfolio and attend webinars to stay updated on market trends and adjust your strategy as needed. Reducing risk in stock market investing isn't about eliminating uncertainty, it's about managing it effectively. By defining your goals, conducting thorough research, diversifying your portfolio, managing your emotions, and staying informed, you can navigate the market with confidence. Remember, successful investing is not about timing the market, but about time in the market. Stick to these principles, and you'll build a strategy that withstands volatility and helps you achieve your financial goals. In the next part, we will explore effective investment strategies for beginners in a changing market. Stay tuned. Effective investment strategies for beginners entering the world of investing can feel intimidating for beginners, but with the right strategies, you can set yourself up for success. In this section, we'll explore 4 proven investment approaches that cater to different goals and risk tolerances. value investing, growth investing, index investing, and regular investing. These strategies are practical, beginner-friendly, and designed to help you grow your wealth over time. 1. Value investing. Value investing focuses on finding stocks that are undervalued relative to their intrinsic worth. Essentially, you're looking for a bargain. Companies with strong fundamentals trading at a discount due to temporary setbacks or market mispricing. Key principles of value investing. Identify undervalued companies. Use metrics like the price-to-earnings (PE) ratio, price-to-book (PB) ratio, and free cash flow to identify stocks that are trading below their intrinsic value. Long-term perspective. Value investing requires patience, as it often takes time for the market to recognize a company's true worth. Example: Warren Buffett, the legendary investor. Warren Buffett is a prime example of a successful value investor. By focusing on companies with solid fundamentals and purchasing them at a discount, Buffett built a fortune through patient, disciplined investing. For beginners, tools like Morningstar and Yahoo Finance can help analyze stocks and determine whether they are undervalued. Focus on businesses with a strong track record, competitive advantage, and consistent earnings. 2. Growth investing. Unlike value investing, growth investing focuses on companies with significant potential for future expansion. These are often businesses in sectors like technology, healthcare, or renewable energy, which are poised to grow faster than the overall market. Key principles of growth investing. Focus on innovation. Look for companies developing groundbreaking technologies or entering new markets. High risk, high reward. Growth stocks tend to be more volatile, but their potential returns can be substantial. Example: technology companies. Companies like Apple, Tesla, and Amazon were once considered high-growth stocks. Early investors in these companies reaped significant returns as they transformed their industries and expanded globally. For beginners, growth investing may require more research and risk tolerance. To start, consider investing in established companies with a history of innovation and market leadership. 3. Index investing. Index investing is one of the simplest and safest strategies for beginners. It involves purchasing exchange-traded funds, ETFs, or mutual funds that track a market index, such as the S&P 500. This approach offers instant diversification and reduces the need for individual stock selection. Key principles of index investing. Diversification. By investing in an index fund, you gain exposure to hundreds or even thousands of companies across various sectors. Lower costs. Index funds often have lower expense ratios compared to actively managed funds. Steady returns. Historically, the S&P 500 has delivered an average annual return of 7 to 10% over the long term. Example: S&P 500 ETFs. Popular ETFs like Vanguard's VO or SPDR's SPY track the S&P 500 index, offering a straightforward way to invest in the overall market. For beginners, index investing is an excellent way to start building a portfolio without the pressure of picking individual stocks. It's also a great strategy for those who prefer a hands-off approach to investing. Number 4. Regular investing. Dollar cost averaging. Regular investing, or dollar cost averaging, involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps reduce the impact of market volatility and eliminates the need to time the market. Key principles of regular investing. Consistent contributions. Set a fixed amount to invest monthly, whether the market is up or down. Automated process. Use automated investment platforms to ensure you stay consistent. Long-term perspective. Over time, this approach averages out the cost of your investments, reducing the risk of buying at market highs. Benefits of regular investing. Reduces emotional decision-making. By investing consistently, you avoid the temptation to react to short-term market fluctuations. Builds discipline. This approach helps establish a habit of saving and investing. Creates opportunity. Having cash set aside ensures you can take advantage of market dips and buy quality investments at a discount. Example: imagine investing $500 per month into an index fund. When prices are high, your $500 buys fewer shares. When prices are low, it buys more. Over time, this strategy helps smooth out the effects of market volatility, maximizing your returns in the long run. Preparing for investment success. To maximize the effectiveness of these strategies, it's crucial to prepare before diving into the market. 1. Build an emergency fund before investing. Set aside 3-6 months worth of living expenses in an emergency fund. This ensures you won't have to sell investments during a downturn to cover unexpected costs. 2. Start small as a beginner. Start with manageable amounts. Even $50 or $100 per month can grow significantly over time through the power of compounding. 3. Use reliable platforms. Choose reputable brokers or investment apps with low fees, user-friendly interfaces, and educational resources. Popular options include Vanguard, Fidelity, and Robinhood. Combining strategies, many successful investors use a combination of these strategies to build a well-rounded portfolio. For instance, start with index funds. Begin with a diversified ETF like the S&P 500 to gain broad market exposure. Add value stocks. Identify undervalued companies with strong fundamentals for long-term gains. Include growth stocks. Allocate a portion of your portfolio to innovative companies with high growth potential. Invest regularly. Use dollar-cost averaging to stay consistent and mitigate volatility. Investing effectively as a beginner doesn't require complex strategies or insider knowledge. By focusing on value investing, growth investing, index investing, and regular investing, you can create a balanced portfolio that suits your financial goals and risk tolerance. Remember, the key to success is patience, consistency, and ongoing learning. By starting small, staying disciplined, and following these proven strategies, you'll be well on your way to building wealth and achieving financial independence. As we wrap up this video, let's revisit the key principles we've covered to minimize risks and maximize success in stock market investing. These timeless strategies are not just for seasoned investors. They're essential tools for anyone looking to build a solid financial future. Key takeaways. 1. Define your investment goals and risk tolerance. Understand your financial objectives, whether they are short-term or long-term, and evaluate how much risk you're comfortable taking. 2. Conduct thorough research. Take the time to analyze companies and their financials, using both fundamental and technical methods. Rely on trusted sources of information to make well-informed decisions. 3. Diversify your portfolio. Spread your investments across different industries, sectors, and asset classes to reduce risk and improve stability. 4. Manage your emotions. Stay disciplined and avoid reacting impulsively to market fluctuations. Remember, investing is a long-term game that rewards patience. 5. Continuously educate yourself. Keep learning about market trends, economic factors, and investing strategies through books, courses, and reliable news sources. By following these principles, you can build a portfolio that not only minimizes risks, but also positions you for consistent, long-term growth. Now is the perfect time to take control of your financial future. Don't wait for the perfect moment or let fear hold you back. Start small, whether it's setting up a savings account for your first investment or purchasing your first ETF. Remember, knowledge without action is just potential. Apply what you've learned today, and let these principles guide your journey. And don't forget, every successful investor started exactly where you are now. Here's a challenge for you. Set a financial goal for the next year. Choose one strategy from this video and commit to it. Share your progress and results in the comments or reach out. I'd love to hear your story. For more insights and guidance, check out these resources, YouTube channels, explore beginner-friendly content from channels like The Plain Bagel or Graham Stephan. Books, The Intelligent Investor by Benjamin Graham and Common Stocks and Uncommon Profits by Philip Fisher are must-reads. Websites. Platforms like Investopedia and Morningstar offer in-depth guides and analysis for new investors. Courses. Consider online courses on platforms like Coursera or Udemy to expand your knowledge further. These resources are designed to help you deepen your understanding and refine your strategies, no matter where you are on your investment journey. Thank you for taking the time to watch this video and invest in your financial education. Your commitment to learning is already a significant step toward achieving your goals. If you found this video helpful, don't forget to like, share, and subscribe to the channel. Your support helps me create more content to empower you on your investment journey. Until next time, happy investing, and I'll see you in the next video.